Hello, in this video, we will discuss capital investment decisions. Capital investment decisions. As a disclaimer, the information provided in this video is for educational purposes only and should not be considered as financial or investment advice. Always consult with a qualified professional before making any financial decisions. The content is based on current information and may not reflect future changes or developments. This is part 1 of capital investment decisions. In this video, we will cover learning objectives 1 and 2. So 1, describe the importance of capital investments and the capital budgeting process. 2, use the payback and the accounting rate of return methods to make capital investment decisions. 3, we'll discuss in another video, is use the time value of money to compute the future and present values of lump sums and annuities. And 4, use discounted cash flow methods to make capital investment decisions. Again, in this video of part 1, we will only cover 2 objectives, 1 and 2. So 1 is describe the importance of capital investments and the capital budgeting process. Now, this chapter focuses on how companies make capital investment decisions, which is a process commonly referred to as capital budgeting. Capital budgeting involves planning for investments in long-term assets to maximize the company's profitability. Now, these decisions are crucial because they impact operations for many years and typically require significant amounts of cash. In our discussion of the master budget, we covered the budgeting objectives, which are or were to develop strategy, plan, act, and control. Now, these objectives also apply to capital budgeting, but the planning process is more complex due to the long-term nature of the assets involved. So we know that capital assets are an operational asset used for a long period of time. Capital investment is the acquisition of a capital asset, and capital budgeting, the process of planning to invest in long-term assets in a way that returns the most profitability to the company. Now, the capital budgeting process begins with developing strategies. Now, these strategies are the long-term goals of the business, such as expanding international operations or becoming a value leader in one market while diversifying into others. Now, this strategic step is crucial for short-term, intermediate, and long-term budgeting. Once the strategies are set, companies proceed to plan and budget specific actions to achieve these goals. Now, in step 2 in capital budgeting process is planning, which involves 3 sub-steps. The first one is identifying potential capital investments, which involves spotting new technology and equipment that could enhance the company's efficiency, competitiveness, and profitability. The second subset is analyzing potential capital investments or analyzing the investments. Now, once potential investments are identified, they must be analyzed using one or more capital budgeting methods to evaluate their viability and potential return on investment. The third step is implementing the selected capital investment. or acquire and use approved capital investments. The fourth step is control. The fourth step is control, which involves monitoring and assessing the performance of the capital investments. In the context of short-term operational budgeting, this step is known as variance analysis. After acquiring and using the capital assets, companies compare the actual results of the investments with the projected results. Now, this comparison is called post-audit. Now, post-audits help determine if the investments are meeting expectations and warrant continued support, or if the project should be abandoned and the assets disposed of. So as you see here in this exhibit, the control steps loops back to the first step, which is developing strategies. The insights gained from post-audit enable managers to learn from their decisions and make necessary adjustments, which are then considered when developing new strategies. Some companies can pursue all potential investments that meet or exceed their decision criteria. However, most companies face resource limitations, and they must engage in capital rationing, which is the third sub-step in the planning process. So capital rationing, it involves ranking and selecting among alternative capital investments based on the availability of funds. Now, managers must decide if and when to make specific capital investments, especially when the company has limited cash available for long-term assets. The fourth sub-step involves comparing the actual results of investments to the projected results. Now, this process, which is known as post-audit, it evaluates the performance of capital investments by comparing the actual outcomes with the expected outcomes. Step 2 in the capital budgeting process involves analyzing investments using various capital budgeting methods. In this chapter, in this series, we discuss four popular methods for evaluating potential capital investments. The first one is payback, accounting rate of return, or ARR, net present value, NPV, and internal rate of return, IRR. The first two methods, payback and accounting rate of return, they are relatively quick and easy to use. They are effective for capital investments with a short lifespan, such as computer equipment and software, which may only be useful for 3 to 5 years. Now, these methods also help screen potential investments, identifying those that are less desirable. The payback method provides management with information on how quickly the invested cash will be recouped. The accounting rate of return, it shows the investment's impact on the company's accrual-based income. However, these methods are inadequate for long-term investments because they do not account for the time value of money. Now, the last two methods that you see here, NPV and IRR, they consider the time value of money, making them more appropriate for longer-term capital investments. Now, management often uses a combination of these methods to make final capital investment decisions. I want you to know that capital budgeting is not an exact science. Although the calculations required by these methods may seem precise, they are based on estimates, predictions about an uncertain future. Now, these estimates must account for many unknown factors such as changing consumer preferences, competition, economic conditions, and government regulations. Consequently, long-term decisions are inherently riskier than short-term decisions. The analysis of capital investments sometimes involve a two-stage process. In the first stage, managers screen the potential capital investments using one or both methods that do not incorporate the time value of money, which is the payback and accounting rate of return. Now, these simple methods quickly weed out undesirable investments. Potential capital investments that pass stage one, they go on to a second stage of analysis. So in the second stage, managers further analyze the potential investments using the net present value and or internal rate of return methods. Now, because these methods consider the time value of money, they provide more accurate information about the potential investment's profitability. Here in this exhibit, it provides you with a summary of the common cash inflows and outflows with capital investments. Now, while GAAP rely on accrual accounting, capital budgeting emphasizes cash flows. The attractiveness of a capital asset is determined by its ability to generate net cash inflows that exceed cash outflows throughout the asset's useful life. It is important to note that operating income under accrual accounting includes non-cash expenses such as depreciation and bad debts. Now, these expenses reduce operating income, but do not involve actual cash payments. Consequently, the net cash inflows from a capital investment will differ from its operating income. So of the 4 capital budgeting methods discussed in this chapter or these series of videos, only the accounting rate of return method relies on accrual-based accounting income. The other 3 methods, the payback, the net present value, and the internal rate of return, they use the investment's projected net cash inflows. Here in this exhibit, it illustrates the life cycle of a capital investment with a timeline representing multiple years. You see here that cash inflows include future cash revenue generated from investment, and future savings is ongoing cash operating costs resulting from the investment, and any future residual value of the asset. So again, cash inflows include future cash revenue generated from the investment any future savings in ongoing cash operating costs resulting from the investment, and future residual value of the assets. Now, cash inflows are projected by employees from production, marketing, materials management, accounting, and other departments to aid managers in estimating the projected cash flows. Now, good estimates are a critical part of making the best decisions. So in order to determine an investment's net cash inflows, the inflows are netted against the investment's future cash outflows, such as the investment's ongoing cash operating costs and cash paid for refurbishment. There also repairs are also included and maintenance costs. So again, to determine an investment net cash inflows, the inflows are netted against the investment future cash outflows, such as the investment's ongoing cash operating costs and cash paid for refurbishment, repairs, and maintenance costs. The initial investment itself is also a significant cash outflow. However, in our calculation, we will always consider the amount of the investment separately from all other cash flows related to the investment. The projected net cash inflows are given in our examples and in the assignment material. So in reality, much of the capital investment analysis revolves around projecting these figures as accurately as possible using input from employees throughout the organization, production, marketing, and so forth, depending on the type of capital investment. So this diagram that you see displays activities over time from acquisition to disposal with usage in the center. Okay, so it begins with acquisition, the usage is in the middle, then to disposal. The corresponding cash flows for each are summarized, where you have acquisition, which are the initial investment outflow, the usage are revenues generated inflows, operating costs incurred outflows, refurbishment, repairs, and maintenance outflows. And of course, disposal involves residual value inflow. All right, so we're starting learning objective 2. Use the payback and the accounting rate of return methods to make capital investment decisions. So how do the payback and accounting rate of return methods work? How do they work? Well, various methods are used to analyze capital investments. Now, one such method is the payback method. And the payback method measures how long it takes to recover the initial investment, also known as what? The capital outlay through net cash inflows. So in general, the shorter the payback period, the more attractive the investment. The shorter the payback period, the more attractive the investment. The calculation of the payback period, it depends on whether the net cash inflows are consistent each year or vary over time. So we will begin by examining these two examples where the annual net cash inflows are equal. Okay? So we're still talking about smart touch learning. So here, this company, Smart Touch Learning, is considering investing $240,000 in hardware and software to provide a business-to-business portal. The short-term, the acronym for business-to-business, B2B, okay? So employees throughout the company will use the B2B portal to access company-approved suppliers. Smart Touch Learning expects the portal to save $60,000 per year for each of the 6 years of its useful life. The savings will arise from reducing the number of purchasing personnel the company employs, and from the reduced costs on the goods and services purchased. The net cash inflows arise from an increase in revenues, a decrease in expenses, or both. So in Smart Touch Learning's case, the net cash inflows result from lower expenses. With net cash inflows, when net cash inflows are equal each year, managers compute the payback with the following formula that you see here, which is payback equal amount invested divided by expected annual net cash inflow. Smart Touch Learning expects to recoup $240,000 investment in the business-to-business portal by the end of year 4, when the accumulated cash inflows total $240,000. So the payback for B2B, business-to-business portal, is $240,000 divided by $60,000 per year will equal your 4 years. Smart Touch Learning is also considering whether to, or instead, invest $240,000 to upgrade its website. The company expects the upgraded website to generate $80,000 in net cash inflows each year of its 3-year life. So the company will recoup the $240,000 investment for the website upgrade by the end of year 3, when the accumulated net cash inflows total $240,000. The website upgrade project has a shorter payback period than the business-to-business project. So you have 3 years compared to 4 years. So in this case, based on this method of analysis, the website upgrade is a more attractive project. Here in this exhibit, you see where the payback calculations are summarized. And remember, these are dollar amounts, okay? So to the left, the net cash outflows, amount invested, $240,000. Business-to-business portal, you see here, and the website upgrade. As I stated earlier, the website upgrade is more attractive, right? Because you're able to see the results within 3 years as compared to 4 years, where they wanted the $240,000. The payback equation works effectively only when net cash inflows are the same each period. For investments with unequal periodic cash flows, you must total the net cash inflows until the amount invested is recovered. Okay, so let's consider the Z80 portal, which is an alternative investment for the Smart Touch Learning Company. The Z80 portal differs from the business-to-business portal and the website upgrade in two ways. One, it has unequal net cash inflows during its life, and they have $30,000 residual value at the end of its life. So the expected net cash inflows for the Z80 portal are what you see here. Year one, $100,000. Year two, $80,000. Year three, $50,000. Year four, $50,000. Year 5 and 6, you see $40,000. So here, the residual value at the end of year 6 is $30,000. So by the end of year 3, the company will recover $230,000 of the initial $240,000 investment, leaving only what? $10,000 remaining. Now, since the expected net cash inflow is in year 4 is $50,000, you see here, the company will recover more than the initial investment by the end of year 4, which is $280,000. Therefore, the payback period for Z80 portal is between 3 and 4 years. Assuming that the cash outflows evenly throughout the 4th year, the exact payback is 3 years plus the $10,000 amount needed to complete recovery in year 4, divided by the $50,000 net cash inflow in year 4, divided by the, yes. So therefore, the exact payback is what? 3.2 years. So based on the payback method alone, the website upgrade does provide the shortest payback period of 3 years compared to the Z80 portal payback period of 3.2 years and the B2B portal payback period of 4 years. So the website upgrade is more attractable, even with the payback period method. Here you see in this exhibit, it compares the paybacks of the 3 investments. Website upgrade, Z80 portal, business-to-business portal. So as you see here, the payback method does not consider the asset's profitability. The method only tells management how quickly it will recover the cash invested. Therefore, even though the website upgrade has the shortest payback, both the business-to-business portal and the Z80 portal are better investments because they provide profit. So the key point here is that the investment with the shortest payback is best only if all other factors are the same. Therefore, managers usually use the payback method as a screening device to eliminate investments that will take too long to recoup the initial investment. Now, management rarely use the payback method as the sole method for deciding whether to invest in an asset. And managers also use accounting rate of return. They also use the net present value and also the internal rate of return to evaluate capital investments. So in summary, when using the payback method, managers are guided by the decision rule, okay? And here you see is the decision rule for the payback. Investments with shorter payback periods are more desirable, all else being equal. But there's a condition. If the payback period is equal to or less than a set amount of time, such as the useful life, that's the condition. Okay? If the payback period is equal or less than a set amount of time, such as useful life. So if the payback period is equal to or less than a set amount of time, such as the useful life, managers may decide to invest. If the payback period is more than a set amount of time, such as a useful life, managers may not or do not invest. Okay, so we're going into accounting rate of return, or ARR. So we know that companies are in business to earn profits. We all know that. The accounting rate of return is a capital investment analysis method that measures the profitability of an investment. So the ARR, accounting rate of return, is only average annual operating income divided by average amount invested. Notice here that the accounting rate of return focuses on operating income and not the net cash inflow that an asset generates. The ARR method measures the average annual rate of return over the asset's entire life. So it is sometimes called average rate of return or annual rate of return. Also, I want you to notice the similarity to return on investment, ROI. It is used to evaluate investment centers. The primary difference is that ARR is used to evaluate the lifetime return of an investment, and the return on investment is used to evaluate an annual return. That's the difference. Okay, recall that the business-to-business portal, which costs what, $240,000? Recall that it has equal annual net cash inflows of $60,000, a 6-year useful life, and zero residual value, okay? So let's look at the average annual operating income in the numerator first. Now, its formula is displayed here, as you can see. The average annual operating income of an asset is simply the asset's total operating income over the course of its operating life divided by its lifespan, or the number of years. Operating income is based on accrual accounting. Therefore, any non-cash expenses, such as depreciation expense, must be subtracted from the asset's net cash inflows to arrive at its operating income. The business-to-business portal average annual operating income is what you see here. The total net cash inflow over the year or over the life of the asset is $360,000. Okay, $360,000. We then subtract the $240,000, which is the total depreciation expense that will be recorded during the life of the asset. So that gives us $120,000, right? Total operating income during the asset's operating life. Next, we divide by the asset's operating life of 6 years, okay, for an average operating income of $20,000. The average amount invested in an asset is its book value at the beginning of the asset's useful life, plus the book value at the end of the asset's useful life divided by 2. Okay, this is what you see here. In other words, it is the asset's initial cost plus the asset's residual value divided by 2. Remember that the book value is a cost less accumulated depreciation. Now, because the business-to-business portal does not have a residual value, the average amount invested is $120,000. Now we're going to look at the Z80 portal. Now, the Z80 portal differs from the business-to-business portal in 2 main aspects. One, it has unequal net cash inflows during its life, and it has a $30,000 residual value at the end of its life. So to calculate the average annual operating income for the Z80 portal, you have the total net cash inflows, which is equal to the total net cash inflow during the operating life of the asset, which is the $360,000. Okay, let me do this again. The total net cash inflows during operating life of the asset is $360,000. The total depreciation during operating life of the asset is $210,000. That's the $240,000 minus the $30,000. So the total operating income during the operating life is $150,000. You're subtracting the 210 from the 360. And then you're going to divide it, that amount by the asset's operating life in years, which is 6 years. And then you get the average annual operating income from the asset of $25,000. So I want you to notice here that the Z80 total average annual operating income of $25,000, it is higher than the business-to-business portal average annual income of operating income of $20,000. Now, this is because the Z80 asset has a residual value at the end of this year, resulting in less depreciation expense each year, which leads to a higher average annual operating income. So the decision rule for accounting rate of return is that if the expected accounting rate of return meets or exceeds the required rate of return, the company should invest. And if the expected accounting rate of return is less than the required rate of return, the company should not invest. Okay, so this is the end of part 1, which we covered learning objectives 1 and 2. So in our next video, we will finish up with part 2. which we will cover learning objectives 3 and 4.
Thank you for watching, and please do not forget to click the like and subscribe button. And if you have any questions or comments, please leave them below and I will reply to you.